Hi there, I'm Nick Stenger. We are the Stenger Family Office. For the past 42 years, it's been our mission to deliver both clarity and confidence to help secure your financial future. One of the big questions we get as financial advisors is, why do stocks continue to go up over time? Well, the simple answer is that stock prices are a basic math equation, and that's simply earnings times price. How much are those earnings worth in the future? In the long run, stock earnings, company profits, are derived from how competent their management team is, how great their business model looks over time, how good their products and services are. Can that company continue to keep up with consumer trends, for example? There's a variety of factors. But over time, if a company addresses the market in a positive way and creates a product or solution that consumers want, over time their stock will go up. In the short run, however, the valuation we put on their earnings, the multiple that we place on their profits, can adjust up or down, primarily thanks to the Federal Reserve. The Federal Reserve is the 800-pound gorilla in the room that none of us voted for, that none of us have any idea what they're going to do on a day-to-day basis. There's plenty of projections out there. There's lots of forecasts. But in reality, the Fed can influence the value of future profits on companies by lowering or raising interest rates. When the Fed is low on interest rates and adding liquidity to the system like we did in 2020, companies become much more valuable because you can no longer just sit in cash or treasuries and make a return. You're forced to buy stocks. In rising interest rate environments like we are today, where liquidity is getting sucked out of the system, stocks become less valuable in the short term because people can go out and buy a treasury or a money market that pays 5, 5.5, and upwards of 6% in interest with relatively low risk. That's all changing now because, remember, stocks are a forward indicator, a forward-looking indicator of what's to come. And so the market never really cares about what's going on right this second. By the time the CNBC or Fox Business article comes out and you read it, it's already too late to react. The market's already looking at next year or the next 18 months, for example. And because of that, over time, what happens is stocks that continue to produce growing profits, growing revenue, great services and products for customers will eventually see their stock prices normalize. In some environments, stocks can become overpriced like they were during COVID. During 2020, 2021, and even a little bit last year in 2022, a lot of tech companies were overpriced with their PE ratios, the price times earnings ratios, hovering around 35, 40, 45 times earnings. Now, that wasn't nearly as bad as the 1990s and the tech bubble era. However, it was higher than markets could support, which is why you saw a short-term decline in the S&P 500 last year in 2022. What we're starting to see now is that investors are overly bearish, they're overly cautious, sitting on more cash than ever before. And what that's done, in our view, is made stocks undervalued today. Right now, basic math, we are trading the S&P 500 at forward-looking earnings in 2024 of $250. If you take 250 and multiply by 19 times earnings, the S&P 500's fair value would be 4,750 points, which is an increase from today's current levels hovering around 4,450. We think stocks, because of this, are not only undervalued this year, but are likely to be undervalued next year. Next year, by the end of 2024, the S&P 500 should trade at $275 in earnings at a 19 forward price to earnings ratio that would push the S&P 500's price to 5,200 points. Because of this, yes, there will be some ups and downs in the short term. Federal Reserve action, either interest rates going higher or lower, are going to impact our estimates, but it doesn't change the fundamental nature of stocks and our belief that we think companies are still undervalued, that investors still have too much cash on the sidelines, and the bears and the doom and gloom pundits, the people who have said the world is coming to an end for the past 5 years now, are going to be proven wrong again, and that stocks, that equities will continue rising higher over time. Our advice is don't panic. Don't get off your long-term plan. Even if you're retired, even if you're 60 or 65 years old, for example, you may have another 20, 25, 30, 35 years as an investor, and that's a long time to become overly bearish, to be overly nervous about the stock market. You want to be on a goals-based plan, not risk-based, that takes a few years of what you'll need in living expenses during retirement, allocated towards a safe spot like short-term treasuries, money market, and cash, and then in our opinion is to have everything else invested in U.S. blue-chip company stocks, which pay dividends. Over time, that's worked wonderfully well for our families, for our clients, and I think it'll work well going forward too. So stay positive, stay optimistic. If you're not using this level of critical thinking in your investment plan, give us a call, 630-912-8431. We offer a starter account program that gets you in the door with just a $1,000 investment. Get to us, give us a call at 630-912-8431. Stay on your plan. We believe stocks will continue to rise over the next few years.